In this question, you're told that the following statements of P&L for the year ended, that is September 2010, were extracted from the books of Bright, Beam, and Light Limited. Then you give and all that, and additional information there. Then you are required to prepare the consolidated statement of comprehensive income, as well as the consolidated statement of changes in equity for the year ended, that is September 2010. So as always, our first step is to draw the group structure and timeline. That should be our first step. So let's read through the question and see. Now, number 1 says Bright acquired 80% of the ordinary share capital of Beam. And then you're also told that Bright Limited acquired 30% of the ordinary share capital of Light. %, there, 30% there. So you already know that Beam is a subsidiary and Light is an associate. What are the dates of acquisition? 1st October 2008, while the other company was on 1st January 2010. So let's now draw my timeline looking at my current year. My current year is ending which date? Can do that by looking at the requirements. That is September 2010. Meaning that my year must have started on 1st October 2009. So when did we acquire all these companies? So Beam was acquired on 1st October 2008, meaning that it was acquired a year ago. While Light was acquired on 1st January 2010, meaning it was acquired somewhere here. 1st January 2010 is the date I acquired Light. So how many months pre and post acquisition? So 3 months there. Therefore, this is 9 months post-acquisition for Light, while for Beam, it is a year ago, so 2 years up to our year end. Very well. Since we are preparing our income statement, we are only concerned with the current year from here onwards. So this means that when we'll be consolidating our revenues for the subsidiary, that is Beam, we'll consider the full year's results because it was there for the entire year. Okay. However, when we'll be looking at our share of the associates results, we look at 9 months results from the date when we acquired Light onwards. Great. Having done this, our next step is to draw an outline of our answer. So remember what we said about consolidation. We only consolidate the parent and the subsidiary. We never consolidate the associate. So what we'll be doing is just doing addition. So we have revenue, just take this plus this. Cost of sales, just take this plus this, and the like. Okay. So we're just going to list them down. So revenues, 1368 plus 774. Then we have cost of sales, which is 810 plus 407. Leave some enough space there. Then have our gross profits. Then we have our investment income. which is 65 plus 0. Our distribution costs, 196 plus 64. Our admin costs, 112 plus 73. Our finance costs, 50 plus 20. Okay, so remember all these numbers, we're just picking them directly. There is nothing we have done that is out of the equation. So we're just taking all these. We've taken finance costs. Okay, great. So let's look and see. Before we look at the income tax expense, know that as long as we have an associate, we have to have a line item for the share of associates' results. So that's a line item we add there. Share of associates' results. Before now we have our PBT, isn't it? And then we'll have the taxes appearing. So when it comes to taxes, we'll just combine all these. Okay, so what I'll do is I'll leave just an extra line item just in case there's something that will be mentioned in the notes. Leave a line item or two, then get your profit before tax, and then now have your income tax expense to give you profit after tax. So for our income tax expense, what are the figures that we have? Income tax expense, so 75 and 15 gives you a net of 60. 43 and 17 since both of them are negative, are again going to give you 60. Okay, so this is negative 60, this is negative 60. These are expenses. So for purposes of our presentation, we're just going to add them together. So when you do that, we get our profit after tax. Once you get your profit after tax, you're supposed to share it between the parent and the non-controlling interests. Very well. So at this point, what I'll do is I'll go through the notes and identify which items are what I'd call free marks, the ones that have not been adjusted. So let's read through and see which notes, which line items have been adjusted. So we acquired Beam when it was that, blah, blah. Okay, so this one is to help us with our goodwill computation, which later on can be used to determine whether or not we have an impairment loss. But as it is in its entirety, there is nothing there. And note number 2, Bright acquired 30% at a cost of 160 million on 1st January. We exercise significant influence. So this one is going to affect our associate results. Just a little bit, because the other things will be from the statement of P&L. We're told during the year they traded with each other as follows. So this one affects. So we have these Beam and Bright, then Bright and Light. Okay, so these ones will affect how we value our sales and cost of sales. So some of these are very straightforward. Let's just adjust them as we are. So Beam and Bright are members of the same group. So the intercompany trading must be factored in. So the intercompany trading was 70. So we have to eliminate 70 from both sales and cost of sales. So intercompany trading. So Beam and Bright, 70 million, reduce sales, reduce cost of sales by that 70 million. So this is working too, yeah. And then we determine whether there is any unrealized profit on the closing stock. We are told that 75% of the goods sold by Beam to Bright had been sold to customers. So it means therefore that 25% are still in stock, isn't it? So unrealized profit on closing stock. So the closing stock is 25%. Let's just put it 25% of the trading, which was 70 million, which basically gives you 17.5 M. Then what is the unrealized profit on closing stock? We are told that the trading was done at margins of how much? Gross profit margins of 40%, which means that GP over sales equals to 40%. So what is the unrealized profit when you have 17.5? Unrealized profit equals to 17.5 times 40 over 100, which gives you 7M. So this 7M goes to increase your cost of sales. Okay. Now, the intercompany trading between Bright and Light. Remember, Light is an associate. When you're dealing with associates, we do not eliminate intercompany trading between the two. So there is no eliminating this. We don't eliminate this. Now, if there had been an unrealized profit on closing stock, it would have affected our accounts. However, we can see that there was no inventory of the goods sold by Bright to Light Limited, meaning that there is no unrealized profit on closing stock. So we ignore all the transactions that relate to this. Okay, so we are done with rule number 3. Number 4, Bright Limited reported its share of dividends received from the investee companies as part of the investment income, but is yet to account for its share of the proposed dividend. Now, we very well know that any transactions between members of the group should not appear. They need to be eliminated. Now, we are told that they have already accounted for the dividend received. So since they have already accounted for it, we must eliminate that. They have not yet accounted for the proposed dividend. So since they have not accounted, it's okay. We just leave it at that. Okay? So the proposed one, ignore. But for this one that they had accounted for, we deduct. So the question then becomes, what is our share of the dividends that have been received? So let's look at it here and see the dividends paid. There was 50 there and 50 here. Remember, our shareholding is 80% here and 30% here. So these dividends must have been received and accounted for under our income as a group. We need to eliminate that. So for Beam, it gives you 40, and the one for Light so these ones we need to deduct them from our investment income. It's working through, isn't it? Yes. Great. We move on. The goodwill arising on acquisition of Beam is impaired by 20%. We don't know what that goodwill is, so we have to first compute the goodwill. That was in note 1. That's why we had left this pending. Goodwill impairment is to be treated as a separate line item in the statement of P&L. So where we had left a space here, we can have it here, impairment of goodwill. It will be a certain working. Yeah, we'll work it last. The fair value of the NCI in BIM at the date of acquisition was 148 million. Again, this one will help us in determining the splits when we'll be looking at the attributable to parent or NCI. We can leave that for later. So basically, in essence, we are saying that there are no other adjustments. So for the other items which don't have adjustments, we can basically finalize them, isn't it? As you wait for the goodwill computation. So for revenues, let's finalize that number. What do we get? Get 2072. What about our cost of sales? We are getting 1154. So our gross profit is actually 918. Investment income, I'm getting it 10. Distribution cost, there was no adjustment, it's 260. Admin cost, no adjustment, 185. Finance costs, no adjustment, 70. Share of associates results, we are yet to work that out. Impairment of goodwill, we are yet to work that out. And then we have income tax expense, that one we can get, it's an easy mark, is 120. So let's work out these numbers then. We have the share of associates results, then we have the impairment of goodwill. So working for share of associates results. Remember from our timeline, the associate was acquired on 1st January 2010. So our share of 9 months results is what we need to take. So what do we have? Light Limited had what as its profits after tax? It had profit after tax of 130. So what is our share? Our share is 30% of 9 months of 130. And when I solve for these, what do I get? I get 29.25. That is the share of our associates results. And come and post it here. 29.25 is a positive. And this is working number what? Working number 4. Sorry, here, working 4. So working number 5 has to do with the goodwill impairment. But before we compute the goodwill impairment, we must first of all know what was the amount of the goodwill, isn't it? So what is the amount of the goodwill? Go through note 1. We acquired 80% of the share capital of BIM on 1st October 08 at a cost of 602 million. When the balance in the P&L was for 80 million, the fair value of the net assets on that date was 700 million at the date of acquisition. Okay. So in this question, we'll be using the full goodwill method. So first, let's compute goodwill. So we'll look at the fair value of consideration that we paid. What was the fair value of the consideration? It was given to us in number 1. We paid 602 million. To these, we add fair value of NCI because we are using the full goodwill method. The fair value of NCI is actually given to us in note number 6. It was the fair value of NCI at the date of acquisition was 148. And then you less the total net assets at acquisition date given to us in note number 1. The fair value of the net assets of the BIM was 700,000. So when I do this, what do I get? I get that my goodwill is 50. Having gotten the goodwill on acquisition date, what is the impairment loss. No, number 5. No, number 5 says what? It says the goodwill arising in the acquisition of Beam is impaired by 20%. So impairment loss is 20% of 50, which gives you 10. So this 10 is what you get to P&L. Remember, later on we'll have to split it between the parent and the NCI. But for our purposes, we are happy with that 10. So come and put it here. And with that, we are able to get our PBT, which when I work out, I'm getting 432.25. Less that, I get 312.25. So now the second part is to us to determine the split between the parent and the NCI. And the way forward is we first work out the NCI balance, and then the balancing figure becomes the parent, because the totals should at the end of the day be 312.25. Okay, so let's work out working 6, the NCI's share of the P&L. So let's look for the NCI. What is the NCI's share? Remember, if we acquired 80%, then the NCI has a 20% stake, isn't it? And we are looking for the share of their profits for the current year. Okay. So the NCI share of post-acquisition profits for the year will be based on 20%. We acquired this entity last year, so it has been there for the entire year. So meaning we are entitled to the full year's profits. And we can see that the full year's profits is coming to 120. Not 120, but 150. Which basically gives you 30. Then we pass our various adjustments, and our adjustments will basically involve any numbers that affected the subsidiary of which we take our share at 20%. And the only adjustments that happened were about unrealized profit as well as the goodwill impairment. So let's look at the unrealized profit that affected the subsidiary. Who was the seller? Beam was a selling company selling to Bright, isn't it? So since Beam is the seller and Beam is a subsidiary, it means that Beam made the profits. But we know that Beam does not control everything, or the shareholders of Beam include the NCI. So we take our share of that. NCI share of unrealized profit on closing stock, 20%. What was the amount of the closing stock? Unrealized profit was 7. So this gives you 1.4. Then we have also the goodwill impairment. We know that goodwill, the full goodwill was at 100. So the NCI's goodwill has to be factored in. So NCI share of goodwill impairment, (20% of the impairment of 10 gives you 2. So when I sum these, what do I get? I get 26.6. So working backwards, gives you 285.65. So that is what is expected of us in the first part of the question that required us to prepare the consolidated statement of comprehensive income, or as we call it now, the statement of P&L. Okay. Then the second part is quite easy. It's asking for us to prepare the consolidated statement of changes in equity. Now, we don't have all aspects of equity. We don't have share capital, share premium, the like. The only things we have are the retained earnings and the NCI. So those are the only ones that we shall be able to draw for. So we have my retained earnings and we have my NCI. So I have the balance as at the start of the year. What is my start of the year? October 09. And then we have profit for the year to give you the closing balance. That is September 2010. So the profits for the year, we already know the figures. There are these figures that we had put here. 285.65 and 26.60. So what was the opening balance? For us to know the opening balance, we have to do a working. So for our working, what I'll do is I'll just draw a timeline. Remember, at what point did we acquire the subsidiary? We acquired it a year ago. So let's look at the parent and the NCI. We are looking at the last year. What are the figures that we are given? We are told, for example, that the retained profits brought forward for the subsidiary are 510. So as at here, it is 510 at the start of the current year. And then we know that when we acquired it, it was acquired when the balance in the P&L account of BIM was 480. Meaning that when we acquired it, it was 480. So it means that last year, the increase was only 30. Out of that increase of 30, the parent took its share at 80%. The NCI took its share at 20%. So note that the parent also has its own NCI, own retained earnings. So what were the parent's own retained earnings as at that date? Okay. So brought forward, it had 714. The parent's own retained earnings is 714. So it basically means this, if I can just summarize, that when we are looking at the balances here, they'll be made up of the parent, 714, plus its share of 24, and then the NCI, which will take its 6. So 714 plus 24 gives you 738. Before now, we add the current year's profits, isn't it? So 738, NCI for last year or 6. So just add them up. And that is all that we are expected to have in this question.